Welcome to the Daily Brief, where I'll go over the action in the market for Thursday, January 5th, and then we'll see how things look for Friday, January 6th. We had another down day, but unfortunately, nothing has really been decided. After Wednesday's session, we were at the top part of this trading range that we've been in. Well, with Thursday's decline, we're back down more into the trading range. So we're still chopping sideways. We're still not really deciding if we're going to take the market higher or lower. There are a few positive signs that I'm going to bring up with some of the charts that I show, but for the most part, things are still looking negative overall. Before I start, this will be the last time I talk about this, because this coming Saturday, January 7th, there is a Market Vision 2023 free webinar that you're welcome to attend. And if you see on the next page, I have a screenshot of this is the only information that you need to give, your name and email address. It's completely free. I have no connection with this whatsoever. I'll just be attending it like everybody else, hoping that we might get some useful information to do daily and weekly analysis of the S&P 500. So let's go back and talk about what happened. Right at the open, we had a lower open, and we opened below the daily pivot at 38.47. We saw some selling coming in rather quickly. It drove prices down to S1, even below S1 at 38.21, and we went almost down to that 3,800 level. The more times we come down and test that, the more important that level is becoming. It started out as more of just a psychological level, but as we keep coming down and bouncing off of it, it's becoming more important from a technical standpoint. So if things really start to go down, we'll want to watch that 3,800 level. So far, it's been holding up. If we break through that, that could really escalate things to the downside. And at least up till this point, if we go down to that level and come back up, we're just treading sideways. We're not really taking anything higher from that point. We need to get above about 38.50 or so for it to really show some kind of a breakout of this range. And not only to break out while the day is still happening, but to close either above and below this range. And even then, we're a little bit suspicious, but that would at least be a start of getting out of this range that we've been in. For those of you that implement a lot of sideways strategies, this is perfect for you. But most folks don't do that. They are trend-based and usually trending to the upside, where they don't necessarily take advantage of things trending lower. So this would be pretty frustrating for folks that do that. As the day went on, we chopped all around. There was just kind of some meandering going back and forth. We were slightly above 3,800, up to slightly above S1. Then we would head back down. After that, we went back down to the daily lows as we entered into the close for the day. We were down 1.16%, and volume was back down to below average. Part of that might be because on Friday's session, we have the employment situation report, and that's been the real Achilles heel, if you will, for the Fed being able to pivot. Things are weakening in the economy overall. Interest rates have been going up, but the Fed is justifying its stance because look at the employment situation. It's still holding up really well. We have a lot of jobs being created. The unemployment rate is still very low. So we can't really stop raising interest rates until we see some weakness in employment. Well, is that what's going to happen in Friday's session? If the numbers come in really hot, then we're probably going to go lower. If the numbers come in a lot weaker, then that could give some support for prices to go higher. But what's typically the reaction to this is it might be kind of a mixed report. It might not show a real slant one way or the other, and we might end up just staying in this trading range that we've been in. The technicals are still negative overall, but there's a few little positive signs that I'll show you, and that has to do with inflation and interest rates. We have the whole list of our geopolitical events, and any one of those can impact the market. But so far, even though those things are happening and they're real and they impact people's lives, for right now, it's the inflation interest rate scenario that the market is really dealing with. Here's the intraday chart showing how we went down quickly right at the open to, again, we opened below the daily pivot. That's the dark blue line. We came down below S1, dropped a bit below that, and then chopped back above it. We ended up going sideways between S1 and S2, which we never hit. Then we came back up slightly as we danced along this 3,800 level, just a little bit above that. You can see at the top that the low was 3,802 for the session. And there wasn't a real lot of conviction. We tried to take things higher, but then that fizzled out, and then we closed down near the low for the day. Please be reminded, and I'll probably stop doing this after this video. I'm just going to put a description in the YouTube and Rumble video section, just saying if you want to look at the daily pivots, they're posted on the community tab on the YouTube channel. I can't really do anything like that with the Rumble posts, but I can with YouTube. But every day I have two charts that I update, a daily chart, which shows the intraday pivot levels for the next day. And then I have another chart that shows the monthly pivot levels, and then I update those with price. So what are some comments that we can make? There are still concerns over a continued tight labor market. We're seeing the weekly jobless claims, they came in a lot lower than expected. So a lot of people aren't really getting laid off or losing their jobs right now. We have the employment situation report coming out, and we'll have to see what that does. Does it make things any clearer, or does it still produce this overall gray picture for what the market can read into that? And then I'll probably stop posting this as well. Starting on January 8th, which is a Sunday, China is going to end their really strict requirements for quarantines for international travelers. And also they're doing that for the Chinese people as well. And a lot of folks are sick in China right now, but it's the Omicron. So it's not the real bad version of COVID-19, but still, it's kind of not very much fun to be sick. But they're trying to lessen those restrictions. Now, we'll have to see. We're getting closer to January 8th. Are they going to change their tune? Are they going to go back and say, no, we need to lock things down again anyway? So just be aware of that. And we did get a couple of different doses of Fed speak on Thursday. The Kansas City Fed president, who's not an FOMC voter, said that she sees the Fed funds rate reaching 5% and staying there well into 2024. The 5% was not necessarily a surprise, and some have even projected that it will go higher than that. It's the well into 2024 that the market didn't really like. But this person is not a voter, and this is not Chairperson Powell. Another bit of Fed speak was from Fed President Byrd, who was a voter, but no longer is. And here's a direct quote saying that while the policy rate is not yet in a zone that may be considered sufficiently restrictive, it is getting closer. And that was taken as positive, but it didn't give an awful lot of support to prices going higher. The VIX is still acting kind of strange, and I have some charts to show you there. Because of this concern with the earnings per share and valuation concerns, that those are being lowered over a period of time, which could justify stock prices going lower. The dollar was up, which provides headwinds quite often for stocks, and interest rates were also up, which also provides headwinds. So that was some of the reason why we couldn't really get stocks to go much higher. And we have pretty much worn off this oversold or extreme negative condition now. We just have one of our stochastic charts that I'll show you, but all the other ones are not registering anything. So we're not oversold or extreme negative as far as the short, intermediate, and long-term are concerned right now. We still have the same yield curves that are inverted and have been inverted for quite a while. Sentiment is still fearful. We're not getting over to that extreme fear camp yet. It'll take a pretty significant down move to really change that. And we're just chopping around within this trading range. And so it's not really having that big of an impact on sentiment, even though folks are more fearful overall. We had the ADP employment change report come out. That came in at 235,000. The last time we had this report, it was 127,000. So that's a pretty big change from last time. Now, this report, which is calculated one way and by a different company or group that does this, they calculate this a lot different than the employment report that we'll be getting on Friday. But to see this big of a jump, that doesn't give a lot of confidence that the Fed is going to be lowering interest rates anytime soon. Weekly jobless claims also came in weaker than expected at 204,000, where they expected at 225,000. The trade deficit actually shrunk a little bit. It's just a mere 61.5 billion, meaning that we're taking in more than what we're sending out to other countries. They expected it to come in at minus 76.4 billion. The last time we had this, it was at minus 77 billion. So that is another sign that the markets didn't really care for. The final IHS market services PMI, the report that came out was at 44.7, and the last time it was at 44.4. So it grew just a little bit. Our trend is still negative and it's weakening. We're now dropping below that moving average. And we're well below 20 right now, because the more we chop sideways, the more this ADX is going to pick that up and continue to register that we're not in a trending environment. Our bias is still kind of mixed overall. You could switch it over to more negative. I'm keeping things at mixed, both for the bias and the momentum, because we're in this range. We get a little bit to the bottom of the range and we bump up. We get to the top of the range and we bump down. So until we kind of get that figured out, our bias and momentum are just kind of in limbo with a lot of other things that we're seeing. This is another chart. I'll probably stop showing this after this video, where the white line just shows how the earnings per share has been decreasing, especially through the last half of 2022. And that is a large part of why stocks are having a lot of trouble going higher. It's ultimately earnings that drive stock prices. This is a chart that I showed in yesterday's video. This is taking the assets of the big three central banks, the Fed in the US, the European Central Bank, and the Bank of Japan. That's the blue line. And when they start to get rid of their assets, which means basically quantitative tightening or lowering their balance sheets, this really has an impact on prices going lower as well. And this has provided a large part of the reason why stock prices have been falling, because when there's more money in the system, no matter what country you're talking about, that money can be used to go into the stock market to buy things. And when you buy, that helps prop up prices. Here's another chart that is more recent. This is showing the ISM manufacturing index. That's the yellow or orange line, and it's really been decreasing. The purple line is the year-over-year change in the S&P, and these two tend to go hand in hand. And this has been declining, so that has also been producing a lot of headwinds for stocks, helping them to make the path of least resistance lower right now. But as I've said lately, we're just in a range. Here's the model that we're going back to from 2006 to 2008. That's the yellow line, and I should be getting an updated version of this chart soon. The white line is what the S&P has been doing. Well, we're just kind of bouncing around, but we are still in an overall downtrend. So if we stick to this model, that could suggest that we might see more weakness in the S&P. Here's the correlation between the VIX and the S&P 500. We're still at a really high level now. You can see I highlighted where we're at. We're getting at that point now where if we finally start to come down, that might be some kind of a spike that we need to pay attention to. Because if you look at other times when we've spiked, and I've drawn the red lines here to show you where was the S&P at that time, and then you can look to see what happened after that. And typically that will produce some kind of weakness, either in the short term, if not even intermediate term. The Ulcer Index is starting to drop. This is showing that fear is subsiding a bit according to this indicator. it's picking up a lot of this sideways action that we're seeing. And so it's like, well, there's not a lot of fear because we're not dropping. We're not really all that happy because we're not really going up. So we're just treading sideways currently. The equity put call ratio, after giving us this massive spike, fell down. Well, with the decline in Thursday's session, it picked back up. And then the one that we pay more attention to is the 5-period moving average of the equity put call ratio. Still have this big spike, but we're not seeing any kind of real capitulation as far as price is concerned. So we're suspicious of this reading right now. Yeah, it could give some support for stocks to go up, but other times when we have a spike and then the S&P starts to go up, that is usually after some kind of capitulation where the market's been going down really far, really fast, and people are very nervous. They load up on their puts because that they use that to protect their positions. And then when that gets to an extreme reading, that typically will mark a bottom. Well, it's different in this situation because as we go sideways, we're still seeing the spike, but it's not really suggesting that selling has exhausted itself. This is just a longer term look at that chart. And down here where I have it highlighted, that's the current value of the 5-period moving average. The ADX continues to drop and we're just slightly below the moving average right now. So we're in a trendless environment. If you wanted to default to something, you would default to the negative because the red line is on top and the green line is declining. PMO, we're watching this one because down at the bottom, we are starting to cross over positive with the PMO based on price. We're looking better, but we haven't quite crossed yet with the PMO based on price. And the two of these together would then help the PMO actually turn up. Slope, after looking a little bit positive with the decline that we saw on Thursday, it's rolling over a little bit, but it's still positive. But all of our other oscillators continue to be negative. The BPI just kind of bouncing around a little bit. It's holding up. It didn't really participate in the downward movement that we saw on Thursday, but how could it? Because we're going in a trading range here, and so it's not really picking up any new buy or sell signals on their point and figure charts. The PMOs that are rising, not giving us any kind of an extreme reading. We've finally been able to work off the buy signals that were giving us an extreme reading, and we're declining as far as those PMOs that are above zero. So I won't show this unless we have a really big day on Friday. This is not giving any kind of extreme reading currently, any one of those charts. Same thing with stochastics. The only one that's still extreme negative is the longer term stochastics, but we've worked off the short and intermediate term readings currently. Here's our daily chart where we had been above the pivot point. Well, with Thursday's decline, we dropped down below that pivot. And if we do start to go higher, you can see there's a convergence between the monthly pivot level here and the 50-period moving average. So we're seeing those kind of on top of each other. That could be pretty significant resistance if we go up. And if we start to go down, at least on this chart, there's really no support until we get down to S1, which is at 3702. That would really take us out of the range and be a pretty monster move, but we have to be aware of that anyway. At the bottom, you see where volume did drop off and is below average. This is something positive to look at, which sometimes the Swinland trading oscillator can be a leading indicator. Even with a down day based on price and volume, this indicator turned up, and both of these are above zero, so that is positive. We're still underneath all of the moving averages in our moving average tree, so if we do try to go up from here, we're going to hit a lot of overhead resistance. The summation index based on price trying to turn up a little bit, but was basically flat. The one that we've been honing in on is volume. And in my classes, I talk a lot more about volume and how it's important. And sometimes volume can lead price. And so that's why we keep an eye on this. This has been turning up, showing that the volume is improving. We're just not seeing it in price yet. New highs, new lows, not really happening all that much. So this is given a chance for our 5 period to show some improvement. So it's turning up and looking more positive. And the 10-day differential is also starting to turn up. So that is positive. But we're not seeing it in price yet, and we're not breaking out of this range yet. The elder impulse system, though, it is now negative. After spending a number of days being neutral, we had enough of a drop on Thursday to change that to a red bar. Our fib levels, where we had been staying above the fib levels on the short-term fib retracement chart, well, now we're just at to slightly below this double Fibonacci retracement level that goes from the high that we set back in August to the low in October, and then another high in September to the low in October. And we have overlapping fib levels here. We're just about on that line currently. Longer term, we also have another double fib level going from the COVID low, and then there was a low back in 2020 to the all-time high, and we're matching up just a little bit below these current fib retracement levels. The weekly chart, we're just a little bit below the 38.2% retracement. That's negative because we dropped down below. Can we get back above that? Another thing that we're really watching for here is this 200-week moving average. If we really start ripping to the downside, but it's like 100 points away or more, 120 points away from where we're at right now. Of course, anything can happen, but we just want to keep an eye on this very long-term 200-week moving average. We came down to this in October and bounced down below it, but then we're able to get back above it. So that's a pretty significant support level. The Copic curve, keeping an eye on this. When these lines cross, that generally suggests that we might see some kind of a move. It doesn't always tell us the direction of the move, but because we've been defaulting to the downside currently, with this crossing over positive, that might suggest that the S&P can go up. So there are some positive things to latch onto in these charts. We just need to get out of this range first and see what direction our price is going to go. This is another one where the staples to the S&P 500 ratio, staples are the things that you have to have no matter what's happening in the economy. When they outperform the S&P, that's more of a defensive move, and usually that happens when the S&P is going down. Well, when this ratio tops out and starts to go down, that means the S&P, or the growth side, is starting to pick up and take over, and we have a pretty significant spike here, and we're starting to come down. Now, we could always go back up and make another spike. We were saying a lot of that for 2022, but this is something to be aware of, and sometimes when this starts to come down, that can give support to the S&P, but we're not really at a bottoming point. You see other times when this happened, this was when folks were pretty freaked out during that time, and not in this sideways complacency of what we've been seeing. The mid caps having given us a recent golden cross, even though they're still below both, the price is below both of the moving averages, but so far this has been holding up. And with the Dow, recent golden cross is still holding up. We're above the 200-day moving average, and we keep kind of dancing above and below the 50-period moving average. So our outlook then for Friday, the technicals, they're negative, and we're just back deeper into that range that we've been in. There are some improvements, and I tried to point those out in this video. The economic reports coming out, the big one is the employment situation report. We'll also get factory orders, and another kind of big one is the ISM non-manufacturing. We had the manufacturing report earlier this week. Now we're getting the non-manufacturing report coming out. And the whole list of geopolitical events with inflation and interest rates being the biggest concern right now. But as I always say, any one of these can come flying in. There can even be one that flies in that's not on this list as things change throughout the globe. So our scenarios can't really go with the down scenario because we're not trending. We're still in that range, even though things are pointing down with our technical picture. Can't go with the up one because we're pointing down, and we're still in that range. The one positive setup that I talked about is the staples to the S&P 500. That is showing some potential, but we're not seeing any confirmation yet. Our technicals are still negative overall. We're dancing above and below pivot levels right now. We have moving averages above where we're at right now, which may provide resistance. So there's just lot of problems that the market's coming into and has been in now for quite some time. And if we go up, we're going to have to see a real pickup in volume. We're going to have to see buyers just massively come in. And if we're going to break down, we're going to see a lot of sellers coming in, but we first need to break out of that range. Not only get above or below that range intraday, but then close above it. So we're still going with the sideways trend, which means some of your sideways strategies, if you implement those, are still what's most warranted. Because the ADX is weakening, we're well below 20. The red line's on top, so we default to the negative. So our conclusion, the S&P is negative and it's in a range. There are a few signs of improvement, but we could lose those quickly if we have a significant down day on Friday. In the short term, we're pretty much negative. We're not showing anything extreme other than that one stochastic chart. Intermediate term, we're not negative nor showing anything extreme. Long term, we continue to be negative. The line in the sand for that one is that we're below the 200-day simple moving average. Thank you. Have a wonderful day on Friday. I will be preparing a video over the weekend, and so I'll talk to you after Friday's close.